A 401k represents more than just a savings account, it's a lifeline to a comfortable retirement. This is a type of retirement account offered by many employers in the United States. Named after the section of the tax code that governs it, a 401k is designed to incentivize long-term savings. But how does it work? Well, it's pretty straightforward. You contribute a portion of your pre-tax salary to your 401k account. These contributions are then invested, typically in a mix of stocks, bonds, and mutual funds. Over time, these investments have the potential to grow, providing you with a nest egg for your retirement years. One of the biggest advantages of a 401k is its tax benefits. The money you contribute is deducted from your paycheck before taxes are taken out. This means you're essentially lowering your taxable income, which could put you in a lower tax bracket. Plus, you don't pay taxes on the money in your 401k until you start making withdrawals in retirement. Another major benefit is employer matching. Many employers will match a percentage of the contributions you make, essentially giving you free money towards your retirement. However, this match often comes with a catch. You usually have to stay with the company for a certain number of years to fully benefit from it, a term known as vesting. In essence, this is a powerful tool for securing your financial future. It's not just about saving money, it's about growing your wealth over time. It's about leveraging tax benefits to maximize your savings. It's about taking advantage of employer matching to boost your retirement fund. It's about planning for the future and ensuring you have the means to live comfortably in your golden years. So, a 401k isn't just a pot of gold at the end of the rainbow, it's the rainbow itself, leading you to a secure financial future. Despite these benefits, the temptation to withdraw early can be strong. Life happens, right? Unexpected expenses, sudden job losses, major life changes, or even the allure of a dream vacation or a shiny new car. These are just some of the reasons why someone might be tempted to dip into their 401k before retirement. Financial emergencies are one of the primary reasons people consider an early withdrawal. Maybe your car breaks down, or your house needs a significant repair that isn't covered by insurance. Or perhaps you're facing medical bills that are higher than you ever imagined. In these situations, it's easy to see your 401k as a lifeline, a ready pool of cash you can draw from to solve your immediate problems. Another big factor can be significant life changes. Maybe you're getting divorced and the financial fallout is more than you were prepared for. Or perhaps you're welcoming a new child into the world and the costs of childcare and college education are looming large in your mind. Again, it's tempting to see your 401k as a quick solution, a way to smooth out these financial bumps in the road. And let's not forget about the lure of instant gratification. We live in a world that encourages us to want things now, not in 30 years. That dream vacation to Bora Bora, the shiny new car that's just hit the showroom, or even the desire to start your own business. It can be easy to justify an early withdrawal from your 401k when you're staring down the barrel of these enticing prospects. But the cost of giving in to this temptation can be high, far higher than you might think. We're not just talking about the immediate hit you'll take in taxes and penalties, but the long-term impact on your retirement dreams. Every dollar you withdraw now is a dollar that's not growing for your future. So before you even think about breaking that 401k piggy bank, it's crucial to understand the full implications of an early withdrawal. Withdrawing early from a 401k isn't just about losing some savings, it's a double whammy of taxes and penalties. Now let's break down this financial 1-2 punch. First, there's the early withdrawal penalty. If you tap into your 401 or K before you turn 59 and a half, you'll have to pay a hefty 10% penalty on the amount you withdraw. That's right, 10% off the top, just like that. But wait, there's more. On top of the 10% penalty, you'll also have to pay income taxes on the amount you withdraw. The rate will depend on your income tax bracket, and could be as high as 37%. So, let's put this into perspective. Say you're in the 25% tax bracket and you decide to withdraw $20,000 from your 401k early. First, you'd pay a $2,000 penalty. Then, you'd owe $5,000 in income tax. That means out of your $20,000 withdrawal, $7,000 would go straight to penalties and taxes. You'd be left with just $13,000. And that's not all. If you're in a higher tax bracket, the hit could be even bigger. In the 35% bracket, you'd owe a whopping $7,000 in taxes on top of the $2,000 penalty. That's $9,000 gone, leaving you with just $11,000. As you can see, the combination of penalties and taxes can take a significant chunk out of your savings. And we're not even considering the potential growth your money could have experienced if it stayed invested in your 401k. In essence, withdrawing early is like throwing away as much as 40% of your hard-earned savings. It's a costly decision that could impact your future financial stability. So, before you think about cracking open that 401k piggy bank, remember the heavy price tag that comes with it. The cost of early withdrawal isn't just about the immediate loss, it's also about what you're giving up. Let's take a moment to ponder on this. What you're giving up, in economic terms, is known as the opportunity cost. It's the potential gain you miss out on when you choose one alternative over another. Now think about your 401k. The money in your account isn't just sitting idle, it's working for you, compounding and growing over time. Imagine a seed planted in fertile soil, sprouting into a tree and bearing fruits year after year. That's your 401k, when you let it grow undisturbed. But when you withdraw early, you're plucking that seedling out of the ground. You're forfeiting not just the seed but all the fruits it could have borne over the years. In essence, you're losing out on a potential wealth of compound interest and growth. So every dollar you withdraw early is a potential future fortune lost. Early withdrawal doesn't just impact your present, it can shatter your retirement dreams. Picture this: you've worked hard all your life, diligently saving a portion of your income into your 401k, dreaming of the day you can finally kick back, relax, and enjoy the fruits of your labor. But then, an unexpected expense arises and you decide to dip into your 401k ahead of schedule. It may seem like a quick fix, but the consequences can be far-reaching. Let's break it down. Say you've been making regular contributions to your 401k for a decade or so, your investments are growing and you're on track to retire comfortably. Then you withdraw, say, 20% of your savings early. You don't just lose that 20%. You also lose the potential earnings that 20% could have generated over the remaining years until your retirement. And remember, retirement savings isn't just about having a nest egg. It's about funding a lifestyle. It's about being able to travel, to spoil your grandkids, to explore new hobbies, and to live without the constant worry of financial constraints. Early withdrawal from your 401k can lead to a significant shortfall in this dream fund, forcing you to compromise on the quality of life you've envisioned for your golden years. Think about it. Will you be able to maintain your current lifestyle with a reduced retirement corpus? Will you be able to handle medical expenses which tend to increase as we age without feeling the pinch? Will you be able to do the things you love, things you've promised yourself you'll do once you're free from the 9-to-5 grind? These are tough questions, but they're essential to consider before making a decision that can impact your future so profoundly. It's not just about the immediate hit your savings will take. It's about the ripple effects that decision will have on your retirement dreams. Remember, the goal is a comfortable retirement, not scraping by. You've worked hard for this, and you owe it to your future self to protect it. So before you succumb to the temptation of early withdrawal, think about the long-term impact. Is the immediate relief worth the potential compromise on your retirement dreams? However, there are certain situations where early withdrawal might not result in penalties. Life isn't always predictable, and the IRS understands that. Exceptional circumstances such as disability or certain unreimbursed medical expenses exceeding a specific percentage of your adjusted gross income can qualify for penalty-free withdrawals. Similarly, if you're facing a severe financial hardship, the IRS may allow you to access your 401k without penalties. Even the purchase of a first home or the costs associated with higher education can sometimes be considered valid reasons for an early withdrawal without penalty. But let's be clear, these are not loopholes to exploit but lifelines for when you're truly in a bind. Never forget, your 401k is your ticket to a comfortable retirement. It's not a piggy bank to be raided whenever you please. So while there are exceptions to the rule, they should remain just that, exceptions. But remember, these are exceptions, not the norm. Before you even consider an early withdrawal, it's important to explore all other options. Remember, your 401k is meant to be a long-term investment, designed to support you during retirement. So, what are some alternatives to consider before you decide to raid your retirement savings? First, think about personal loans. While they do come with interest rates, these rates are often much lower than the potential penalties and tax implications of an early 401k withdrawal. Plus, a personal loan won't impact your retirement nest egg, keeping your future financial stability intact. Next, consider home equity loans. If you're a homeowner, you may be able to tap into the value of your home for some immediate cash. This option can be particularly useful for larger expenses. However, remember that your house serves as collateral in this scenario, so it's crucial to ensure you can meet the repayment terms. Another possibility is negotiating with creditors. If your early 401k withdrawal is motivated by debt, it's worth reaching out to your creditors. Many are willing to work out a repayment plan that fits your current financial situation. This could mean lower monthly payments, extended payment periods, or even reduced interest rates. Alternatively, you might consider adjusting your budget or looking for ways to increase your income. Sometimes cutting back on non-essential expenses or picking up a side gig can help bridge a temporary financial gap without jeopardizing your retirement savings. Lastly, don't forget about the power of community resources. Local charities, religious organizations, and government programs often provide assistance for those facing financial hardship. These resources can sometimes be the lifeline you need to get through a tough financial patch. Without tapping into your 401k, there's almost always a better solution than raiding your retirement savings. Remember, your 401k is more than just a savings account. It's your ticket to a comfortable and secure retirement. So, before you think about breaking that piggy bank, consider all available alternatives. Your future self will undoubtedly thank you. The best defense against the temptation of early withdrawal is a good offense: planning for emergencies. Think about it. Your car breaks down, your roof springs a leak, or you lose your job. These are all very real possibilities that could see you reaching for your 401k savings. But what if you had an alternate plan? Having an emergency fund is your first line of defense. It's a separate savings account that you contribute to regularly and only tap into when unexpected expenses come knocking. The general rule of thumb is to have 3 to 6 months worth of living expenses saved up. However, this can vary depending on your personal circumstances. But what if we told you that it doesn't just stop there? Other financial safety nets include having the right insurance policies in place. This might mean health insurance, home insurance, or even income protection insurance. These policies can cover you financially when life throws a curveball your way, helping you avoid dipping into your retirement savings. Similarly, maintaining a diverse investment portfolio can provide a buffer against financial emergencies. Investments such as bonds, stocks, and real estate can provide financial relief when needed, without sabotaging your retirement plans. Setting up these safety nets might seem like a daunting task, and it does require discipline and sacrifice. But the peace of mind that comes from knowing you're prepared for life's uncertainties, that's priceless. Remember, your 401k is not a piggy bank to break when times get tough. It's a nest egg, carefully built over years, even decades, to ensure you can live out your golden years in comfort and security. So, before you find yourself in a financial pickle, start planning. Establish that emergency fund, get insured, diversify your investments. Because when it comes to your financial future, prevention is always better than cure. Your 401k is for your future, not for present emergencies. Finally, let's touch on the psychological impact of early withdrawal. It's not just about the numbers and the financial implications. The mental and emotional toll can be just as significant. The stress of facing penalties and taxes, the regret of seeing your hard-earned nest egg dwindle, these can lead to a great deal of anxiety and worry. In contrast, consider the peace of mind that comes with knowing your 401k is secure and growing, steadily building towards a future of financial freedom. It's about the reassurance of knowing you're on track to meet your retirement goals, the comfort of having a safety net for your golden years. And don't underestimate the satisfaction of discipline, of resisting the temptation and staying the course. It's a testament to your financial maturity and commitment to your future. Remember, your 401k is a promise to your future self. Don't break that promise.